Well, hi, everybody, and welcome once again to our Markets and Economic Market Review. And I'm Michael Moskal, Director of Investments at MGO, and with me here today, John Conry and Parker Kasgan. And we are going to talk with you about a number of topics today. Hey, guys, what about this year so far, by the way? This has been a heck of a year in the markets. We had the market hitting new all-time highs in February, and then we had the anticipation of the tariff start. Big sell-off happened, especially after Liberation Day in early April. We had about a 20% drop in the US stock market. And only then after that, we've had this huge rebound. And I think, John, it's the fastest recovery or one of the fastest on record that we've had.
Yeah, outside of COVID, it's definitely the fastest one.
Yeah,
And
so COVID was the fastest one. This one was about what, 6 weeks?
yeah, and it's almost like it's been like 3 years of market in 7 months, right? Does it seem like that in terms of everything that's happened?
It does. It does. You had this such massive optimism, then pessimism, then optimism.
Yeah.
It seems like you've packed in all these years in just 6 months or so.
Exactly. Yeah.
So some of the topics we're going to talk about today, the AI revolution continues. That's a big deal. I think everybody understands the impact that AI in all different facets of our lives is going to happen. Most everybody I talk to now has had in one shape or form used ChatGPT, or other forms of that, and improving the way that we communicate and be able to factor in things. But we'll talk a little bit because AI is not just about technology. It factors into a lot of different kind of industries in the stock market and the impact in our lives. So we'll talk about that a little bit. Tariffs, we just mentioned a little bit with tariffs. We haven't quite seen probably the outcome of this. I would say that right now it's much more positively impacted than what we thought it would be, earlier on. A lot of that is the president and the administration has backed off of their extreme, views back in April with Liberation Day when they were going to tariff everybody 70, 80%, 140% with China. And they've come way back on those. And we'll see in a minute, 15% seems to be about where they're at with that. John, you want to mention about the big, beautiful bill?
Sure. The Republicans got their bill passed on July 4th, which was Trump's expected date, or hope to get that through, and they got it through with the narrowest of margins, but they did get it through. The biggest takeaway is that the tax rates will stay the same. If they didn't do anything, everyone's marginal rate would have gone up about 2 or 3% at next year. So they call these rates permanent, but they're not really permanent. They can be changed by another Congress in the future, but we at least know we're probably in pretty good shape here for the next few years. A couple other changes. The biggest change too is a SALT deduction came back. They took that out a few years ago, and all the high tax states like New York, Connecticut, California, they were all upset about that, but they did get a SALT deduction of up to 40 grand, but it is income limited. Again, that's in terms of what you can deduct for your state and local taxes. They did increase the child's tax credit. Trump had campaigned a lot on no tax on tips or overtime. That's in the bill, but it's limited. It's limited to income levels, and it only goes through 28. So we'll see what happens in a few years. They also increased the child tax credit, and there's also a credit now if you buy an American car. I think you can get up to $10,000 of a write-off of the interest that you would pay. That I think is retroactive to January 1. There's also a new account that for babies, the government will give them $1,000 to invest in an account that has to be in there, I think, for 18 years, and it's to be invested in a S&P 500 fund. On the business side, the biggest takeaways are the QBI deduction remains, which is a qualified business income deduction that businesses get, and there's also accelerated depreciation. So if a business buys some type of capital equipment, they can deduct 100% of the cost of that in year one. And historically, when government's done this, it spurs a lot of business purchases. So hopefully that will begin to play out as we move through the year. And then lastly, from an estate standpoint, the estate tax exemption is going to still be 15 million. So it had been potentially dropping to 5 million, which would have ensnared a lot more taxpayers be subject to estate taxes. But that's at a $15 million level, it's less likely to impact people. So that passed in as well.
Yeah, so a lot of activity, and there was 1,000 pages, by the way, right? So it was 1,000 pages, and I'm pretty sure if I'm betting money, I'm pretty
Mhm.
sure that there's not a whole lot of Congress people that read 1,000 pages of the
No.
bill.
Yeah,
So there's probably things in there we don't even know yet what are in there, but it's gonna estimated to add about 3.4 trillion to the debt. That's probably the downside because there's a lot of giveaways in this bill. But
sure.
we'll see what happens. Parker, do you want to talk a little bit about interest rates?
Yeah, so Trump's been pressuring Powell to, cut interest rates recently, and you may have seen in the news their little press conference and Trump slapping Powell on the back and encouraging him to cut interest rates. Not expecting to see a interest rate cut this upcoming meeting, but we are expecting to see one in September and then another one by the end of the year. So I'm sure Trump won't be too happy about not getting his interest rate cut now, but he'll probably get it by the end of the year.
Yeah, and it's not, you look back in history, every president, pretty much every politician wants to have rates lower and lower, right?
Yeah,
Because it spurs economic activity. The lower the rates are, the more people will borrow money to buy cars and houses, and businesses will borrow. And, so they're all looking for short-term boosts in economic activity to help reelection, for
right.
people. All right, just a real quick comment here. This is our 86th year in business. I thought it would be kind of fun to put a few pictures up here related to 1939 when we started. So the car that you see there, that is the one of the first sports cars, and one of the cars from 1939 that everybody wanted back in those days. It's a Buick Roadmaster, and it went up to 100 miles an hour, which was almost unheard of back then in 1939. So the baseball player that you see here, because it's summer and it's baseball season, so that's Joe DiMaggio, one of the best hitters of all time. And Joe DiMaggio played for the Yankees, and he was the MVP in 1939 in baseball. And I thought it was a kind of interesting listing the prices of things in 1939. And if you look at the average income back then was what was it, $1,729. That's about 70,000 now into today this year. New car was $700, and the average new car now is $40,000.
Mhm.
These numbers just are funny.
Yeah.
A new house back then was $3,850. The average price of a new house today is $400,000. Loaf of bread was 8 cents. It's $2 now. A gallon of gas is $3 now. It was 10 cents. Gallon of milk, 49 cents, $4. Gold, what's gold, guys? Gold was $20 essentially an ounce back then. Where are we
Yeah.
at with the gold price per ounce? We're at about 3,400
33.
dollars at
Yeah.
this point. Silver was 38 cents an ounce. 38 cents. We're at $38 an ounce now. And the Dow Jones was at 142. 142. Where are we at now?
40.
44,000, 45,000.
Yeah, we're 44, 45,000. So pretty now, of course, inflation over the years, of course, adds to a lot of this, but a lot of those prices are above inflation. Certainly the prices of cars and houses are more than what the average inflation, if you just inflation adjusted, it'd be more than that. All right, take a look at the markets for this year through June 30th. Parker, you want to take MGO equity ETF?
Yeah, so our equity ETF portfolio has obviously been performing really well for the year. So we benefited from increasing our international exposure going into the year. Also increased our gold position, and we have a silver position in the portfolio as well. So really performed well this year, and not just this year, but the past few years. So we're actually the leading benchmark on the ones we have listed here out of the four.
Yeah, yeah. So if you look at this year, so we have the highest weighting, I believe, in international or non-US stocks that we've had since 2011, which is a long time. But we started increasing our international exposure, I want to say it was about 18 months ago.
Yep.
And then it's about 32% of our portfolio, our equity ETF portfolio at this point in time for our equity position. Is about 32% is in non-US, which again is the highest since 2011 that we've had. And non-US is up 22% this year, something like that.
Yeah.
So it's given a big boost. Gold, the gold stocks are actually up more than bullion is this year. So gold stocks are upward anywhere between 50%, somewhere in that range, 50%. So that's also given us a big boost with that portfolio. And, like Parker said, by the way, if you add up these numbers across from 22, 23, 24, and 25, those years, and then you add those numbers up and you compare our equity ETF portfolio to the S&P 500, Dow Jones Global ex-US, which is non-US stocks, and then Bloomberg US government as bonds. We were up about 37.3% total return. S&P is up 33.6. Non-US is up 14.5% over that time period. And bonds are actually negative 2.4. So, pretty happy with the way that our management has been with our equity ETF portfolio. John, you want to talk a little bit about gold? Gold's been on its big run.
Sure. Like Michael said before, it's been really helpful to our portfolios and outperforming. And it's, as you can see, it's the only asset class here that we're showing here that has been positive the last 4 years. And Michael had mentioned earlier that it's actually outperformed the S&P 500 over the last 25 years, which most people would not believe that, but it's up 596% versus 549 for the S&P. So pretty significant performer. And what you see is that in times of stress, 22, when the S&P was down nearly 20%, gold was up 1%. And, if you look back in history to, 2001, 2002, and the internet blew up, the gold was positive then. So it's been a steady kind of ballast to the portfolio. Oil, different story, negative every year for the last 3 years, was positive in 22, but there's just too much supply out there now. And that's part of the reasons. And, I know Trump wants to get these companies to drill more, but I don't think they really like drilling much when oil is under $55. So I don't think that's going to happen. But it's one of the positive things is that it's not really a shock to the market anymore in these Middle East events. So there was some concern about the Strait of Hormuz closing. Market kind of shrugged its shoulders at that. We're a much bigger producer here in the U.S. now than we were say back in the 70s. So it doesn't really impact the market as much. And energy as a whole is really a small component of the S&P now. It's probably south of 5%, I think.
3%, yeah, 3%.
Yeah.
And positive for the oil prices, obviously going down means that for you and me and everybody that has gas-produced cars, that has
Right.
internal combustion engine cars, that the gas prices are lower.
Yeah.
Well, that's a positive that happens out of there. With gold, by the way, and because we get this thing, Parker, you're going to talk about Bitcoin in a minute. Gold, because we get the question a lot, why is gold going up like that? And there's more than just one reason. But you look back over the thousands and thousands of years that gold has been around as a store of value. There was times when gold was used as the currency, in certain societies and countries. But gold has been also a hedge against declining currencies. When you have countries that are printing money in large amounts, like the US is, and like Europe is, and just about every developed country in the world right now has been printing a lot of money, that, gold traditionally has been this hard money that people will invest in gold as a protection against the devaluation of currencies. So that's also, one of those reasons why we see gold going up. Parker, Bitcoin?
Yeah, so Bitcoin's obviously the most volatile thing we have up on here, down 78% in 2022, but then up 156%, up 111%, and then another 15% this year. So Bitcoin, I think right now it's at about $118,000. We obviously had the current administration's very pro crypto, so that's been a nice boost for them in 24 and then going on to this year. And although we don't have it in our equity ETF portfolio, we are announcing a new portfolio that we're going to have, the MGO Alternative Growth portfolio, which has some Bitcoin, some Ethereum in there, some private equity. So we're going to send some more communication out on that coming up, but we're excited to launch that portfolio.
And I think that's actually up 17% for the year, that portfolio.
Mhm.
Very, very aggressive.
Yeah.
Not for everybody.
Right.
It also can be down a lot too.
Yep.
We mentioned tariffs already. Again, we've been pleasantly surprised. I think the whole investment community has, and maybe everybody has, how this has unexpectedly gone pretty well. And we're getting deals done. Countries are accepting tariffs higher than they were before. I think our average tariff rate prior to these deals being done, we had tariffs before, by the way. Tariffs are not something new. The first tariff, what was the year of the first tariff? You guys, I'm trying to remember if it was 1789 in this country.
Oh,
So
yeah.
it's not like this is something new that's been happening. And it's not just the US. There's many countries that use tariffs. But I think our average rate of tariff was about 3.5% prior to all the tariff stuff going on now. So 15% tariffs is still a pretty big increase. but it's a much less increase again from the outset of Liberation Day when the president had that big whiteboard on there and he was talking about 70 and 80% tariffs. So, things have been negotiated quite well. We get people that think that tariffs are the greatest and people that think the tariffs are the worst. The honest answer is there's pros and cons to it, like everything else. And we haven't really seen some of these cons in here. I don't think, John, yet. I think the CPI numbers and the other inflation measurements haven't shown that there's been higher consumer prices at this point.
Right. We have not seen that yet.
I think what we're hearing more so is that corporations are actually eating it. So if they're importing if they're importing goods and from foreign places to make their own products here in this country, someone's got to pay for it. And at least right now, it sounds like the corporations are eating some of that. So, it's early on in the game. There's just these deals. We've got to give it probably 12 months to see where this all shakes out.
Yeah, and one thing too about revenue, these tariffs have generated 100 billion already this year, and estimates are that it'll generate 300 to 400 billion in revenue to the country once everything's fully implemented, and that could be about 3 trillion over 10 years is kind of what I think what Scott Besson said. So,
Yeah, assuming nothing changes,
right.
again, countries are accepting the higher tariffs, and it's just that is a pro. The pro is that it does mean immediate revenue coming into the country.
And that 100 billion, I think, is already the highest on record for the United States to ever bring in
Right.
as far as tariff revenue. So
Yeah.
through the year, and you already broke the record.
And actually, in the month of June, the government had a positive balance, for the expenditures for that 2 months in a row, and that hasn't happened since 2014.
Yeah, so that again, these are for the pros, and so far it's so good. We're still looking for the $2 trillion to wring out of excess and expenses somewhere, but
Right.
the tariffs go a long way with that.
Yeah.
Just quickly on deglobalization, that again, the tariffs are sort of part of this. And you look back at 1987, it was interesting with Ronald Reagan, and I think we've mentioned this in these videos before, where he got up and that's Miguel Gorbachev there, the Soviet Union premier, but he said, "Mr. Gorbachev, tear down this wall." And they did. They actually tore down the wall that separating East Berlin and West Berlin at the time. And then the Soviet Union, of course, fell, and it kicked off a 30-year cycle of globalization where countries were working well together, more trade, more working together. And when countries are working together more and they're making money off each other in trade, the risk of having a major conflict, we've had conflicts obviously globally, but any kind of world wars, those kind of things, the risk of that happening goes down way, way down. It's very low. So, when you start building walls, of course, it starts adding a little bit of conflict in there. And we'll see. Maybe it means nothing, but we're watching it very carefully because it could mean something. And all these little charts on the right side here are just different countries. I'm not going to go through them all, but with the tariffs going on, there have been higher unfavorable ratings coming on with these countries the way they look at us. So, nothing's happening now bad, but we got to kind of just keep an eye on it. We mentioned about the AI revolution. It's estimated that by 2029, you're looking at trillions of dollars being spent on AI systems. And, corporations in this country are estimated spending about 48% on an annualized basis, spending 48% more on AI as time goes on. That's a big impact to the economy. So it's a big tailwind for the economy and also for the markets. And it permeates different kind of companies, different kind of industries. We're not going to go through all these on here, but obviously NVIDIA, Meta, Microsoft, everybody knows what those companies are. NVIDIA makes the big chips that everybody needs. But companies like GE Vernova and Vertiv, which are in the energy sector, NuScale, which is a nuclear company, Constellation Energy. Someone's got to make these big data centers that these companies are spending money on to run AI. And Caterpillar, cat, you see the cat symbol there. Someone's got to build the stuff. Cat's down there. Siemens is in that same area too. So it permeates all different kind of industries. Right now technology is getting a lot of positive feedback, but you're going to see a lot of permeation with these different companies and different industries. And so we're buying a lot of different industries right now. We've increased our industrial position and, looking in the energy sector, because again, these are sectors that are benefiting from AI.
Yeah, speaking of Vernova, I mean, they reported earnings last week and the stock was up think 15% in a day, and it already had a huge recovery since April. So, that they're right in the mix here. And this was the company was spun off of GE a few years, I think 24, right? So
Yeah, GE spun off their I think they spun three of them off, so their subsidiaries.
yeah,
But yeah, so it's Meta and Microsoft, the big hype, they're called hyperscalers, okay? The big trillion-dollar companies, and Tesla's in here. They're spending trillions, and they're going to spend trillions over the next 10 years. They're spending billions now, and they're all trying to outspend each other. And again, they're buying some of these big data centers, and they're buying some of the nuclear companies actually, right? Aren't they buying some of the nuclear power plants?
yeah. I think Amazon bought 3 Mile Island, didn't they?
Yeah, they
Yeah,
did. You're right.
yeah,
They did. They're trying to all one up each other and buy energy essentially to be able to run these big, huge data centers.
yeah.
Parker, you talked about the Fed cutting rates. We see the president here, President Trump and Jay Powell. This is just from, I think, from Friday last week.
Yeah, so like I said, I have Trump's pressure and Powell, and looking at two interest rates this year. I think right now it's projected to have two more interest rate cuts next year. So a lot of politicians also like interest rates just because it's easier to go back and talk about how you can get a cheaper house now, or your mortgage payments less, your car payments less, might have a lower credit card payment. So it's a lot of pressure on Powell to cut rates, but so far he's held strong, and we'll see how it goes through the rest of the year.
Yeah. So mention also the interest costs
Yeah, so
on U.S. debt.
yeah. So that's another thing that Trump wants the rates cut for, is so that there's not so much interest expense, so you can say you kind of balance the budget. So that's a big topic. And I know he wants his interest rates around 1%. So I think that would, I forget how much we're paying a year in interest expense on the debit. I think it's like
Close
250
to a trillion, close
billion.
to $1 trillion actually
Yeah.
at this point, which is, I think we're spending more on defense. That's what I read. So defense spending is like 800 billion, and we're spending close to $1 trillion annualized now in interest
Yeah.
costs on our debt. So of course, every little bit they can try and drop those rates and get those rates down just decreases the interest cost. It's
I
not,
think if each percent it goes down is another 250 billion they save.
yeah, so it's not a good reason to keep racking debt up, by the way, but but
Yeah.
but it does make a difference, and that's the reason the president's putting pressure also on the Fed to cut rates. Longer term outlook, what we look at when longer term is not what longer term used to mean. So, looking out though the next 5 years, I tend to look out maybe the next decade, but looking out the next 5 years, certainly, the non-US stock rotation that we're seeing now, again, non-US stocks are outperforming US stocks for the first time in many years. And in the last 15 years, there's only been 3 calendar years that non-US stocks have outperformed. So 12 out of 15 times US stocks have outperformed. And that doesn't last forever. At some point in time, you just get stocks cheap enough in the foreign sector. And there's good companies there too. Siemens was on our chart. Siemens is a German company. So there's many, foreign companies that are very, very good in all the different sectors, technology and industrials and energy. And when they get cheap enough relative to the US stocks, you start seeing money start rotating in those areas. So, we're going to keep our weighting probably high in non-US stocks, and we think that rotation continues. Value stocks, again, you look at different sectors like financials and industrials. Value stocks, we see that rotation happening too, and that's these two little graphs that you see here on the right side. That will go through a time period, 5 year, 7 year period. We're going to see value stocks outperform. So we're starting to build our positions there to get ready for that to happen. We mentioned higher debts and deficits. It's going to have some upward pressure on interest rates in the long term. In the short term, certainly you can see the Fed cutting rates, but in the long term, when you keep issuing more and more debt, and what is debt? It's just U.S. Treasuries, and someone's got to buy them. So the more supply there is out there, it's going to have an upward pressure on interest rates in this country. So, any other comments you guys have with these items?
Yeah, in terms of debt, I mean, the big concern is that if we don't get our fiscal house in order, it's just going to create this cycle where people won't want to buy our debt and their rates are going to go up to attract people, so to buy the debt. So it really is important that they get that under control and get spending under control, and hopefully the economy will cooperate, and we'll see some rate cuts that will help that.
We've been talking about that for a long time, right, John?
I know.
Getting spending under control in this country from the U.S. government's perspective, it's
It
hard to
seems to
do.
be a little more serious now.
Yeah, it is getting more serious.
Yeah.
And the good news is this, that, the odds of something really bad happening right now are small because the US dollar is still the reserve currency of the world. Many assets are priced in dollars. You look at oil, gold, US stocks are the dominant asset class in the world priced in dollars. So as long as the rest of the world needs US dollars, in trade and other investment, then it creates that demand, and it creates sort of this floor underneath what can happen with your currency. But that's not always going to be the case. So we got to watch that very carefully and try to see where that turn comes because it's going to mean something different that we want to be investing for clients.
Yeah, exactly.
One of the other
Okay.
things I saw is
That,
some new crypto legislation. They're making the stable coins by U.S. Treasuries now, so kind of
yeah,
almost forcing
that's
them
a
to.
it's a great point. The Genius Act, I think it was, right, Parker?
Yeah.
Yeah.
So Congress just passed this Genius Act, which was trying to legislate stable coins, which is in the crypto area. We don't have time to explain it all, but they are requiring these stable coins, which are just crypto. Okay, they're electronic tokens. They're requiring them to be backed by very, very stable and low risk investments, which would be essentially U.S. Treasuries, short-term Treasuries. So I think the number Scott Bessent gave was $100 billion of demand for U.S. Treasuries when they do that. So yeah, that's a good point, Parker. Okay, well that's it. Thank you for watching. We'll be back to do this again, and we'll keep working hard to invest your money and keep the returns going as best we can. And any questions you have along the way, just let us know. Thank you.